What's going on, everybody? It's Ask Me Anything Happy Hour, and I'm actually going to put the happy back in happy hour today. We used to do this show and always had a cocktail, and that has just fallen by the wayside. So I think there we go. He's got a cocktail. I'm going to go get one in a bit. But you know what? We do this show for you. We do this show to answer your questions. We just finished the wealth webinar. We do WTF every week, and that generates a lot of people that have a lot of questions. So we're hoping you are on here, and we are all here like the Brady Bunch to answer your questions. So we're going to get to that right after this. All right. Welcome, everybody. Welcome to Ask Me Anything Happy Hour. And we are here to answer your questions like the Brady Bunch. We always start the same way. We go around the block, starting with the crazy man who's been in the chair way too long and is getting a bit loopy, but Mr. Snaggy up top.
It is true. I do get cabin fever, especially on these Wednesdays when we have webinars and podcasts and live streams going all day. But it's a lot of fun. I just don't get to get up and move around as much as normal. But with that being said, it's a beautiful day in the neighborhood. Things are great. The happy hour, just to be clear, the happy hour for Ask Me Anything started when we were all locked in our homes during COVID. And that's this is one of the programs that we launched during that time. And so I don't know about you guys, but during COVID, I think I was drinking every single day. So it just made sense while we were doing Ask Me Anything that we would just go ahead and have a beer during this. Now that we're back to real world in 2025, I personally don't drink alcohol during the week, but which is probably a good thing.
You make up for that on the weekends, though.
You make up for it on the weekends, sure. But yeah, I'll throw it over to Mr. Joe Helock. What's up, Joe?
As to 4.5 hours of sitting in the chair for Zooms today, so I can feel both of your guys' pain. So I'm here to answer questions in regards to HELOCs and IBC and real estate. And so have them come in so everybody can answer them. And down to Jason.
Thank you, Joe. Hello. Happy, wonderful Wednesday from the City Beautiful. Happy to be here as always. Get your questions in the chat. Let's get them answered. Live streaming. Figured out how to do that. Technology is my friend today. So that's something that's pretty exciting. Right, Joe? You know that struggle. That's why you laughed.
Yeah.
I'm going to go over my buddy Ethan here, who is disappearing into the wall. So hello, Ethan. How are you, man?
I'm doing great, Jason. Coming in from the mid-Michigan area and also from the implementation team. It's been another full day of calls, helping clients to not just get started with IBC, but also to keep implementing and keep using the policies that they already have. Look for how to continue to adapt that to the current goals and current challenges, and just keep optimizing and just focusing their mindset. So we're glad to be here with you all and excited to answer your questions. So over to Brian.
Hey everybody, Brian Felcher up in Northern Idaho. The last probably week of really hot weather, so kids are getting ready to go swimming and do all the kind of fun stuff right before school starts next Monday. So I'm excited for a quieter house, to be honest. So there we go. But I'll leave that and go down to Craig.
Good afternoon, and I would have to echo what everyone's saying. Wednesdays are our BYOB family days because we've got Stephen and Chris are on the WTF, and then we have Joe and Stephen and Chris and myself are on Wealth Webinar today. And then we have this agent training where all of us are on there talking about things. And I think we spend a lot of time together on Wednesdays. But anyway, it's cool. We're all family. Sometimes we want to, like family do, and put each other in a headlock and move or whatever. But it's all good. Happy to be here to answer your questions. And I'm going to pass the baton over to our good friend, Linus.
For anyone listening, before we go to Linus, Craig was just saying he's had enough of all of us. Let's get the questions in so he doesn't have to talk to us anymore. So over to you, Linus.
That's right. Hey, everyone. Linus here from Hopkinsville, Kentucky, working through it's nice to be working indoors in the air conditioning with these dog days of August, that's for sure. We've got the heat, that's for sure. Yeah, I'm excited to help answer any questions that I can, help all of you recapture your money that's leaking out of your family and to grow your wealth. Carson, let's hear from you.
What's up, everybody? Welcome, welcome. Excited to get your questions in here today. I've missed the past 2 or 3 AMAs. Grateful to be here today. Those of you who have been following the story along, we finally had our baby a couple weeks ago, August 5th. Baby boy, his name's Wells. I will show you guys a photo at some point, but it's been fantastic first 2-3 weeks. We love him a lot, and it's been great. So that's been what I've been up to, and finally getting back into things this week. So excited for you guys to be here and Ask Me Anything. The name is Ask Me Anything on purpose. Please ask us anything you want, and anything you want at all, primarily in real estate, IBC, and HELOCs and all that. But any questions you guys got, we're here to help. So thank you for being here today. Chris,
do you have any questions coming in? Hey, where's Sean, by the way? Sean,
right? Hey, Carson, also, you're not the only one that brought a new one into the world. Jordan Wolf just had his baby the other night. So, yeah, it's a pretty exciting time over here at BYOB and Companies with you having your baby and then Jordan having another baby. It's pretty awesome, man. Pretty awesome.
And I'll say this, it goes very quickly because my son just walked in the room. I feel like he just had him yesterday, but he walked in the room just now and goes, "Did you see my comment?" And I looked over in the comments.
Yes.
And, there he is. He's on my account, but I didn't.
No way. Look at that.
My goodness. What's up, Bryce?
I saw that, Snaggy. I was excited. I was wondering if Courtney had the phone or Bryce had his own phone, so that's cool.
That is awesome. Oh, my goodness. Love it. Yeah, and one final thing before we dive into the questions, we'll let them build up a little bit. We'll definitely get them all, but super exciting day today. Like 15 minutes before Wealth Webinar started, Craig and I were like, "Hey, should we?" And Craig's like, "I don't know, should we?" And I'm like, "Yeah." So we actually did like a pre-launch, we called it the early bird launch of the Vault software, and that was like our first time. To say that we weren't ready to do it, we weren't, but it's fully ready from a software standpoint. And he gave a demo of it. And just, I think for me, we've been working on this thing. I hate to say Craig has been working on this thing for like 2 years. I've just created the platform and the stupid visionary ideas. And when we showed it to everybody, including, Harrison George and some other folks from the industry or outside the industry, it was just almost like, everybody was like, "Holy shit, what did you guys create?" Did you not feel that, Craig?
Yeah, it was really awesome to hear all the comments and even Harrison, sitting there like, "Oh my gosh, I'm gonna get this thing."
Because we've kept this thing so close to the chest. I mean, our mentors, everybody here has seen it, but we've not shown it to the public pretty much at all. I mean, maybe bits and pieces, but we haven't. And today we didn't even show we probably showed a quarter of the capability of it because we only gave it 20 minutes to kind of offer it. And, it does so much more than what we showed, but just the little bit that we did show, people were just blown away. And that just made me feel real good. Anyway, enough of that.
I just want to say it just really is coming from a place of what we do every day and what we teach. It on the surface is easy, but when you get into the implementation, you start bolting on velocity banking, all these other things. We wanted to make it easy for you, the community, to use the same strategies we do. So anyway, we're really excited about it. We're just, I don't know, I think about it all the time. Always thinking about how can we make this thing better? How can we help you guys? But yeah, it's a great day. It's going down in history for me at 8/20/2025, the soft launch of the Vault.
That was a very soft launch. I don't even know if I'm going to call it. When people say, when did you launch? It will not be this date because it wasn't even a soft launch. That was just hey, pitch the ball to me. Let me try to swing and hit it. And I just connected with the ball. It was just weird. It was just so awesome, though. And it's just I just cannot wait till we show a real launch of what the software is capable of because I've never seen anything like it before in my life. It's truly going to change not just an industry, but a lot of people's lives for the better, and puts the power back in, the middle class and the client's hands. Really does. So
and collectively, what we're trying to do is take all of our brains, everyone you see here, take our brains and put it into software that you can use. So,
and our tagline is visualize your financial future. And boy, I'll tell you, that's exactly what it does. But enough about the Vault. Steven, we got a bunch of people and some questions piling in here. So who wants to read them off? We don't have Shauna, so it's either you or Brian.
All right, cool. I think Fouts has a good voice for the
He
question.
does. It's like that radio voice.
Yeah. All right. J10, welcome, man. So it says, Jens, after you paid into the policy for the 10 or 20-year term and decide to use the remaining cash value for an investment, does the death benefit stay intact permanently? So I never understand that. So 10-year terms, I mean, one, address the 10-year term. So, or 10 to 20-year term. You can actually pay in longer than that if you want in most cases. So keep that in mind. So that's just,
Oh, I got tripped up when it said term. I was.
Yeah. You can pay in long. With whole life policies, yes, there is a term where the premium will start to drop eventually, and every company is slightly different, but it's up to you oftentimes when you start to drop the premium down. So keep that in mind.
Yeah, I mean, typically we'll illustrate them showing the term dropping in year 8, which is after the 7-year, right, the Max 7 pay, or year 10. And usually when we drop the term, depending on if there's a big dump in or not, there's a lot of factors. It's a pretty significant drop in the death benefit. But then very quickly after that point, because you're in a very efficient point there, the extra PUAs you're putting into the policy drive the death benefit up quite fast. Does it ever? It doesn't so much get right back to where it was with the term, but that's why we're always talking about this, and we say the death benefit is kind of something you need to factor in, that it's going to be less than it normally would be in a regular whole life. So you really a lot of times want to make sure that you're properly covered, or talk to us about that, and we can either keep that term rider on longer, extend it. And I know some of you have been kind of playing around with designs where you keep the term on for 20 years instead of the 10 or the 7 years. So I know we're monkeying around with lots of different things, and it's all, that's why, like, when we say these policies are designed and engineered for you, for your needs and goals, like, that's not a joke. That's not just a tagline. It literally is custom built for you. It'd be like buying a Rolls Royce. You want white stitching and orange seats. They'll build it the way you want. You want it to have your ex-fiance's name embroidered in the seat with like a big X over it. They'll do that for you. Well, we can do that with policies too. I have no idea why I just said that, but
that was interesting. Anyway. I like that one. But
yeah, I don't know why.
I don't think he's referring to term insurance though either. I think he's referring to the amount of time that you fund the policy for.
Yeah, I would just swap the word term for duration, and I think
and that duration is up to you. But the other part of his question here is, when you use the remaining cash value, well, the word kind of remaining kind of catches me a little bit, because it's not remaining cash value. It is the cash value. It's not remaining. It's just the cash value in the policy. But when you borrow out of the policy and put it into the investment, yeah, the death benefit doesn't change. Nothing changes. It's intact and it keeps going. The only time the death benefit would change is if you pass away and there's an outstanding loan, then the death benefit is reduced by that loan. So hopefully that makes sense, Jay. If not, just let us know. Anybody else?
I think that was the only point I was going to make, is if you have a loan and you die, it comes off the death benefit.
Yeah,
that's it.
Cool. All right. So John has a question. I think he has a couple parts to this one. So John says, if I was to pull $100K from crypto and implement it, what would be the guesstimate monthly payments or premium deposits, as we call them, to carry that specially designed policy on BYOB?
About 12.
And he's saying an initial deposit, we call those a dump-in of $100,000 to fund the cash value early on. Then his last comment here is, I know it will create a huge tax implication once it's removed from, you're referring to the crypto. Yes. If there's gains there, yes.
I would look at it from a standpoint of how much do you want to be saving into your banking system on an ongoing basis.
Yep.
If you're going to start with 100,000, maybe some of that needs to be the first year's premium as well, not just the dump in, because that is kind of two separate amounts you look at. But yeah, what can you save on an ongoing monthly basis, or quarterly, or semi-annually, or annually? And yeah, you get on a call with us and we can talk about it.
Yeah. And the premiums, I mean, there's a minimum to make that dump in work, yes, but you can go up from there depending on what your goals are, as Linus is saying. So yeah.
For efficiency in the second year, it'll be between 10 and 15.
Yeah. Yep. And then the tax thing. Yeah, I've been having a lot of tax questions, by the way, everybody, on recent calls about how can infinite banking help save on taxes. That's always an interesting question. So,
what do you tell them?
It depends. It all depends on the person, what they're trying to accomplish. A lot of it comes into a company. Someone says, "Oh, I have this company. Happened today or yesterday. They have a door installation company. They just started. They're saying, can we have the entity own it to save on taxes?" And I'm like, yes, but is that the best decision though? Because then you have to explain to everybody. So if a corporation owns a policy, yes, there can be an agreement between you and the company to where the premiums can be deductible. Once again, not tax advice here. But if the ownership of it's ever changed out of the LLC or out of the business because you sell it or you close it, all of a sudden there could be a huge tax implication because you transferred from the business to you personally. And now it's all taxable. That's once again, not tax advice, but you've got to be very careful about that. So those are the kind of things I get into. But I always say go ask your CPA. All right. Bay Wilson says, hi, Barrett Bay here. We have an annuity with a guaranteed of 7%. Would it be smarter to try for a whole life policy to pay off bills? We are 69 and 72 years young.
Young, I love it.
Well, it's interesting. You have an annuity with a guarantee of 7%, which to me would say that you have either an indexed annuity that says it's a guaranteed 7%, but may or may not be a true 7% guarantee. And an annuity probably wouldn't be a good vehicle to pay off debt. It's typically not the right type of machine you would use to pay off debts. So I think probably the easiest thing to say would be it'd be worth a phone call. That's for sure. At 69 and 72 years young, it's going to kind of make it a little bit harder for us to design a policy that has that real high cash value, but not impossible. I think, unless anyone else says anything different, Bo, I think the best thing to do would be, or I probably said your name wrong too, would be to book a call with us and we can kind of go into the details on what that annuity really is. Is it immediate annuity? Is it a deferred annuity, with an indexed option? I don't know, but looking at your needs and goals and figuring out what one's going to work best.
Yep. All right. And for everybody else, get those questions in the chat there. Because we're going to run out here pretty soon. And so Jay has another question. It says, having a direct recognition policy with Guardian, is there a time where it doesn't make sense for IBC? Loan rate versus dividend crediting rate may be inversed. So anybody want to explain direct and non-direct first?
Yeah. So great question, Jay. And for those of you who don't know what this is, so there's different types of ways insurance companies can recognize dividends and pay you as a policyholder a dividend. And so it's called direct versus non-direct recognition, which essentially means they will, I look at it as they will directly recognize how much you've taken out as loans against your policy. And so they will not pay you a dividend on the entire amount of cash value, rather what's left over. Whereas a company that's non-direct recognition will not recognize how much you've taken out as loans, and they'll pay you a dividend on the entire amount of cash value in the policy. So obviously, if you're here learning about infinite banking, you're thinking, I want the compound interest. I want the policy to keep growing while I use the cash value. You're probably right. You probably do want a non-direct recognition company to do the policy with. And so this question is asking, well, hey, if I have a policy with a company that is direct, so you can take loans, but they will not pay you and credit you an entire dividend amount because you've taken some cash value out. And he's saying, does it still make sense to do banking with the policy, even if like my loan rate's super high compared to the dividend I might be receiving? And my answer would be, yes, it still makes sense because of multiple reasons. But if you are taking a loan from your policy and paying it back with interest, even though it's interest going to the insurance company, you as a policy holder will earn a higher dividend essentially if the insurance company is more profitable. And if you're paying them more money, they're going to be more profitable. There'll be more dividends. So not that you paying them interest directly means you're going to get the exact same amount in a dividend, but by working with a mutually owned company that pays dividends and you using a policy, paying interest, taking cash value loans, and using this money in and out of your policy, you are in complete control of the entire system, which is why we call it you are becoming your own bank. You are the one earning interest while you use your policy, while you use your money, while you have guarantees, a death benefit, all the good stuff. So I personally don't think it's a massive deal if you have a direct versus non-direct company. However, if you have maximum loans all the time, yes, you probably do want a non-direct company to work with, but it doesn't necessarily mean you can't do banking or it's a bad idea. And then to take this question a different direction, probably something Craig would have said, if you do show a spreadsheet of taking a loan and paying it back and being an honest banker with yourself, the actual interest amount you would pay is not going to be higher than the dividend you would accrue, most likely. So even if you had an 8% loan rate, but you repaid it in banking the right way, you're probably not even going to pay a full amount of interest, and you're probably still going to make more money on the policy. So if you look at it that way too, you're probably fine. And that's why another reason, direct versus non-direct, you can work with both types of companies. What did I miss?
And boom, he drops the mic, he walks off, home run. I would say the other part of it that, you covered, but it would be good for Jay to hear it, would be that when you're filling back up, like you're repaying the loan, you can borrow again when you have enough opportunity fund to go put the money to work again. So in another scenario, like even if the interest rate was lower, which it's not going to be, but if it was and you're out, borrowing money from the bank, you don't have control over how you're going to pay it back. The interest is going to be amortized most likely, and you're not going to have the money at the end. That's the point I'm trying to make. You'll have the money back for whatever it was that you purchased, whatever investment inside the policy. You fill it back up, and then you can put it to work again, because that's what the banks are doing. And that's why we're teaching. We're so passionate about what we do. So,
yeah. And, Jay does bring up a good point. And I had a conversation with a client about this, and it was with a Penn policy, Penn, great company, by the way. But they took out a bunch of money. They didn't know it was direct recognition. They didn't know what that even was. The agent never told them, and we didn't set this policy up, of course. They borrowed the money out, and they had the interest, and all of a sudden, the numbers did not look the same as the illustration because of that. And so they had interest and a reduced dividend, and there's a negative arbitrage potentially there. So that can potentially happen. This client, when they found out after I told them, they were not very happy, to put it simply. So you got to be kind of careful about that. Yeah, good point.
I would just mention, it's kind of sounding like, Jay, like you already have a policy with Guardian. I would be very slow to recommend or tell you to switch that over to a different company or to even get rid of it. A policy like this with a mutual carrier that pays dividends is a very valuable asset you do not want to give up easily. So
well said.
That's something we would want to look at. Get on a call with us. We can take a look and evaluate your existing policy and see how that was designed, if it is good for infinite banking. There are some designs where it could make sense to do a 1035 exchange over to a better design at maybe a better company, but that's not necessarily a cut and dried thing. We'd have to go over it with you and evaluate that.
Yeah. Yep. And also there are ways where you can use the cash value as collateral for a bank line of credit, and that avoids the direct recognition, by the way. Now the interest rate might be slightly higher than what, like, say, Guardian might charge you, but you'd have to do the math on that, and that could potentially make sense. So, but that'd be a call that we can help answer that. All right. So Joe says, how does the insurance company recoup the money they loan me from the general fund when I make the monthly payment to pay it back if the payments go to my policy?
They're charging you a simple interest on the loan is where they make a little bit of money. I think that's part of the question, or what he's wondering.
Yeah. So the loan is coming from their general fund to you. That's an asset to the insurance company. Yeah. It's part of their portfolio of assets because you're paying it back with interest. The interest goes to the insurance company's general fund. Your cash value is the collateral for the loan. So that's really how they're recouping it, because you're paying it back. So
Well, like, think about a HELOC too. If you've got a HELOC from First Savings Bank and you pay back the HELOC, so you're paying it back to your HELOC, it's going back to the bank. It's not going back. It's your HELOC, but it's the bank you're paying back. Same with this. You're paying back the insurance company. It's just a line of credit that your name's on against your policy. So the same kind of idea.
Yeah. Got a good analogy there too.
And I don't know if Joe's thinking this, but it's a common thing I hear where
Joe's not thinking anything.
there's actually two paths of money. So Joe, you have your premiums going in, and that's going to be on a regular basis, either monthly, quarterly, semi-annual, or annually. When you take a loan to go do something, and let's say you take a loan to go buy a car, all we do is we'll structure repayments just as if you took a loan from the dealership. Those loan repayments are a different stream of money because you have your premiums. That loan repayment goes back on the loan side. So you have two things going into that policy, premiums and loan repayments. And if you were going to pay the dealership $500 a month for 60 months, well, then that's what you want to put back in your policy. And like we've discussed here, and Carson made mention about the interest arbitrage earlier, is if you're paying a 5 or 6% policy loan interest rate and you're paying it back, you might effectively be paying 2%, 2.5%, 3%. Just depends on how you're paying that back because of the simple interest. So just remember there's two streams. There's the premiums and the loan repayments going back to the policy.
There we go. All right, anyone else on this one? All right, this is a question for Chris, who is looks like John Cena all of a sudden. There you go. There he is. So John says, Jonathan says, I have a question for Chris. I have looked closely at your spreadsheet for Vivi's Lucky Genes. Lucky, I love that name. I think I've heard you say that those loans were never repaid. Is that the case?
They were, but also in that example, we didn't account for the loan interest. So it's a bit skewed. So when we're showing that, we're just really just trying to show an example. So in that scenario, if you watch the video, you always hear me say I would never do it this way. I would always have recaptured it. Back then, when we did that example, we should redo that, Craig. We didn't have software that could actually show all the mathematics behind that whole thing. So yes, there was no loan repayment shown in that particular example, but what that would account, what you'd have to look at, this is a very important factor to that, is you'd have to account that those outstanding loans that weren't repaid, that there's loan interest on those. So when I did that, that loan interest would have been between 4 and 5%. Today it'd be more like 5.25. So next to an impossible calculation to figure out going in reverse order like that. But you'd have to assume that I was making those interest only payments on those loans during that time. And then when I was gone and Vivi took over, she would be making those interest only payments on those loans. Kind of like if you had, a line of credit that you just kept out and you never repaid the principal, that would be how you'd have to look at that. So that's a very important factor to look at when you're looking at the Vivi Lucky Genes.
Yeah, he had an additional follow-up thing here. It says on that policy, wouldn't the interest charge be in another column and part of the total input into the policy?
Yeah, that's what I was just saying.
Yeah. There you go. Yeah. All right.
So I got to redo that. So actually, thanks for bringing that up, Jonathan, because that kind of motivates me. And Craig's already got his, Excel sheet kind of going. Actually, now I don't even think he says that anymore. I think he said his vault mind going, where we're going to actually redo the Vivi Lucky Genes, but we'll do it where we show all factors, recapturing, recycling, all that good stuff. I think then it'll be a lot more exact, but the outcome will be about the same. You just have to consider. In that one, I was assuming I was paying the interest or Vivi was paying the interest.
And for anyone who doesn't know what Vivi Lucky Genes is, you should go watch the video, go watch why Chris did it, and also think about why not have one thing that can take care of any big expenses coming up in your life for your entire life. Mm-hmm. Whether we're talking cars, weddings, you're talking about retirement, you're talking about helping Chris in his old age, which you'll have a nice long-term care, but helping take care of your parents. You can set this thing up and have it pay for all of those things. And that's what he shows, that making one decision early on for Vivi is going to change the rest of her life.
Yeah, I think another thing, just the last thing I'll say about the Vivi Lucky Genes is that video, that's a very old example, but that video was shown to give the power of compounding interest over a long period of time. That's really what we're trying to show there, because really, if you watch that video and you carefully look at it, all we're showing is the policy. We're not showing infinite banking. We're showing taking money out of the policy and using it to pay for things, but we're literally not showing the infinite banking concept at all. We're just showing the power of a policy over time. And I've kind of done additional policies with my New York Life policy, the $389 one that I show all the time. And that's another example of this is just the power of just the growth of the policy Forget about the infinite banking concepts. This is just a stupid whole life growing over a long period of time, being used to fund the things that we would always need to fund for children. That's it. It could be done so much better, and we will do it much better.
And for all your new dads out there, kids ain't cheap.
No, they are not.
Kids ain't cheap.
Just don't pay them.
Stay away from travel hockey, I'm told. One teacher at her summer camp was like, oh, she really liked hockey. You should get her into one of the teams. I'm like, nope. She's a snowboarder, and that would interfere. Avoiding that one.
And hey, Steven, can you put in the call link that is for this event? I know there's a special one we have. All right, Dexter, what's going on, man? He says, I have an 8K policy loan called today. I have another 8K available with policy still. I paid the loan of $8,000 today. After it clears, I have 16K available. Yes.
Yes. And it'll be probably about 10 days, Dex.
Yeah, there's a little time frame. They got to load it back up.
They tell you 10. You might have it available a little sooner, but they're trying to make sure the money actually comes back before they'll make it available.
Some carriers are 15 days.
I learned something. Thank you, Linus. That's why I come here, really. I just want to learn something from you guys. It's helpful.
But in Dexter's case, there will be some loan interest that gets paid out at 8K, so the full amount is not necessarily going to show up as a full 8,000.
One America?
Is it One America?
I don't know. I was kind of curious.
Yeah. I think.
It depends on when they charge the interest, though. Yeah, it depends on when they charge the interest too on that one.
Yeah, One America pre-charges, Lafayette charges at the end of the policy year.
Yeah.
So it just depends.
Yep. All right, so, and that's a great point that I've been bringing it more to people. Like when you pay the principal back or the loan, you're paying principal, not interest. So it's 100% principal, which is why it affects the interest rate so much in a good way. All right, so Arrowhead says, we have an IBC policy and are building our first home with it. That's awesome, by the way. Congrats. We try to only use recycled money for all of our living expenses and building expenses. So that's awesome right there. So, I mean, I'd be curious to see, what kind of a size policy that is. Obviously, if you're doing a home with it, it's probably got a sizable amount of cash value. I'm curious as to how long you've had it as well, but that's amazing right there. You're in full control. So infinite banking on steroids right there. And then so he says, follow-up question is, can you give examples to multiply our money with a tight budget while building out of pocket?
I think as you're
recapping, having infinite banking, so that's the first thing.
One thing I like to go over with clients is, even if you don't have, a large enough chunk to go invest in this or that or the next thing, you can still, finance your own, personal needs at the household level. We all pay, most of us, pay, property taxes, have car insurance or renter's insurance, homeowner's insurance, whatever. You can take a loan, pay that car insurance bill or whatever that is, pay that ahead for the 6 to 12 months, and now that monthly car insurance payment that you're giving to State Farm or Geico, put that back into your bank. And if you can even add another couple percent on top of that, now you're paying back principal and interest, and you're just paying it back faster. And then, as we were just talking about with the previous questions of the power of decreasing that loan balance that you have back, and the benefit that has of reducing your effective interest rate, that would be a way to kind of keep making more money by recapturing more of those pennies that are kind of bleeding away towards interest.
Anyone else? Jason?
No, that was good.
All right, so this is awesome. So Christian, he was late because he was playing around with the vault. I was messing around in the vault, and if I up my policy premium back to what it should be, would I be able to catch up the past, say, 3 months, and would I get an updated in-force policy illustration? Yes and yes.
Well, he can catch that up, but he should check with the carrier first to make sure, and ask how much PUA premium that policy can hold before actually making the contribution, so you don't accidentally mech the contract. As far as the updated in-force policy illustration, you should ask your implementation agent for that, although the carrier could probably also provide it if you ask.
Yeah. And then does it also depend on the anniversary?
You can load that into the vault after you get that, Christian. As soon as you get that in-force policy with the new numbers, then upload it to the vault, and you'll have those new numbers to deal with.
And just so you know, Christian, your IT specialist is Larry. So it's Larry at themoneymultiplier.com, and he can help you with whatever you need.
Look at that. Good job, Steven.
Yeah, I was thinking the same thing.
Yeah. Not just a pretty face.
Yeah, knuckles.
And there's no hat today. It's kind
I
of
think
throwing me off.
Steven and I are on the same program, stepping away like for a second just to eat. Wednesdays, you don't even get to eat.
That's awesome. All right, what else we got here? Okay, so Joe says, if I pay the $500 per month to the policy and the simple interest is going to the insurance company, in my mind, the general fund would become depleted eventually. Keep in mind, in the words of Forrest. So okay, when you say $500 per month, I think you're referring to paying the loan back. Is that correct? I'm assuming that's what you're saying. The simple interest is going to the insurance company. Yes. The insurance company's general fund would become depleted eventually. Well, no, because when you pay that loan back, you're paying back their general fund plus interest. So their general fund is actually increasing when you pay back the loans because it's an asset. The loan is.
He thinks that the insurance company is lending out all of their money to everybody too, and it's only
That's a good point.
Yeah,
it's about maybe 1% of their 2% of their total assets or policy loans.
General fund is huge.
They're huge.
These are big companies, like
$100
really
billion.
big. Like it take. I don't even think my iPhone would hold enough zeros just to account for the amount in their general fund.
Yeah. So the low policy loans are a very small part of their portfolio.
very, very small.
And when you make payments back to your policy, those payments are principal repayments back. So if you were doing $500 a month recycle recaptures back to your policy to repay the loan, then 100% of that money you're putting back in is repaying principal. The insurance company, depending on the one, like either one is up front and one is behind. Typically, I'll just use the one behind. The interest is all charged for at the end of the year. So essentially, unlike a line of credit where when you make a payment to a line of credit, you're paying some principal, some interest every single month. Here, if you did it every month, 100% is going to pay down principal. And that's what the vault really allows you to do, is see the mathematical advantage that gives you. And we were kind of surprised because we never really thought about that. But the fact that the insurance company isn't diluting your payments when you're paying down your loan, like that little bit extra, makes actually a big deal. It's a big deal over a period of time, like 3, 5, 10 years. It makes a huge difference. And the vault enabled us for the first time ever to actually see the mathematics on that. We were quite surprised.
And that's awesome, Chris. And Joe, like, think about it this way. If it's a $10,000 loan you're paying back at $500 a month, or say you're paying it back the whole loan in 6 months. Well, then if the interest on the $10,000 loan, call it $600, you only pay $300 in interest, and you'll have filled up the cash value again, so you can retake another loan for something else that you're going to use it for.
Yeah, and his comment right here, so the $500 per month loan payment is not going into the cash value. No, it's not generally. It's going into it because the cash value is just the collateral that collateralizes the loan. Think of like a mortgage. Your home is the collateral for that loan. It's kind of the same thing. The home doesn't go anywhere. It doesn't lose value per se. It's just been collateralized. Same thing here. The cash value doesn't go anywhere. It's just been collateralized.
Yeah,
that's what was going on.
But effectively, like, I could side on Joe's side here. Brian, in theory, or not theory, but in practicality, you're right.
Yeah.
But every payment of $500 back to the loan payment gives the client $500 more to use.
Correct.
It's really a component of more the collateral. You're repaying the collateral, but to them, it would seem like they would have more cash value to use. Their cash value is not going up, but they're having access to the cash value that was used prior.
Yeah.
I think of it like a gas tank. So when I go fill up my car, I don't have an electric car, but I go fill up my vehicle with gas, I'm full. I drive, my gas tank gets empty. I go back to the gas station, it gets full again. That's just kind of what's going on with your cash value. You've got X amount of cash value. You take a loan, it goes down, you pay it back, it comes back up. And there is some compounding and growth going in there while the cash value is growing while you're using it. But one of the things I look at, and I'm kind of reading into some of his questions, is when you put money into, when you put premiums into the policy, it's not like there's a little box at the insurance company that says this is Joe's money. It's going into their big general fund, and they're doing a ledger accounting of this is how much cash value Joe has available to him, and this is his death benefit. that if you were to pass away. So all that money's going into the general fund anyway. When you pay loans back, you pay premiums, it's going into that general fund, and they're taking that money and either loaning it out to a policyholder, or they're putting it into bonds, buying real estate. And Chris and I, Chris just walked away, but we were in Cincinnati with Lafayette, and we were both just blown away because we were being toured around the city by one of the Lafayette folks. Like, we own that building, we own that building, we own that building, and we own that building. Oh, and the hotel you're staying in, we own that too. Oh, and this building over here where we're leasing it out to people like $2,000 to $12,000 a month, we own that building too. So that general fund is buying all of that stuff. It's buying all those assets, and
That's cool.
that's just one city. You know what I mean? It's just like just blew us away. But that's where that money's going in, is into that general fund.
Yeah. And this is a good question here. I mean, the loan payment doesn't help the cash value grow. It just replenishes it, like we're saying.
Yeah.
But it's not actually it's growing by you funding it, but the payments back aren't funding it. They're just giving you more to borrow back again.
Yeah, Brian, let me jump on this one. So I've got a diagram that I've made to talk about this specifically with clients. And so I kind of show it as like, you've got like your premiums are like going in the front door of your bank as your new money. And when you take a loan or pay the loan back, it's like your dollars are going to work for you through the back door, like the service entrance. So they're coming in through two different ways. And so essentially it's kind of like how if you take a piece of real estate, say you've got a property that's worth $100,000. If you take a mortgage or a HELOC against the property is worth 100. Let's say you can borrow 90 against the property. So you're taking the bank's money collateralized by that property. And then as with the gas tank analogy, as you pay some back, now you've got more that's available. But paying back the mortgage or the HELOC doesn't make the house worth anymore. If you were to sell it, it's still worth it's still going to sell for 100. But your takeaway, your difference of what you can access is what changes as you take out more loans or pay the loans back. And then that also goes towards where how do we make the policy grow by taking out loans? That's where you have to put extra paid up additions in. That's where your I-team specialist will help you to look at, okay, can you squeeze in any more? And now you're putting in more new money into the policy. That's increasing your cash value, which then increases how much you can borrow against that cash value.
Which leads us right into Dex's question. I was curious if that is what Dex is talking about in that question right under the highlighted one.
This one?
Yeah.
Math check. I put 18K into policy. I'm accessing 16K, so I'm borrowing almost 90% for every dollar I've deposited, making sure I'm doing my math right. It depends on how you put that money into the policy. If it's a dump in, then yes, you're correct. It depends on how
it could be additional paid up additions, which would also be correct. And usually like maybe Dex is asking, you have more cash value always than what you can actually access, what you can actually borrow. Like the insurance companies don't want you stripping that thing all the way down. They want a little bit of cushion. Is my understanding. It's usually like 90 to 93% of the cash value is what you can actually borrow. Does anyone know anything different, or is that pretty accurate?
Well, Lafayette can be
a couple
quite
points higher, but
yeah, like Lafayette's pretty high. I've seen some where they're borrowing a lot.
I guess that's my trying to under promise, over deliver. I try to have that as a theme always, right? So.
Yep. All right, we have some questions here. Let's get through these ones. Dobbsy says, I just received my health exam results. What happens next?
Wait for approval. Hopefully you get approved quick. If not, we got to then determine what to do, but hopefully you get approved and you can meet with your strategy call specialist, go through the policy plan, the illustration, your goals, and get something moving.
Yeah. So the results go to the insurance company's underwriter, and they'll review the results and continue the underwriting process. That's technically what happens.
Typically, you should get some news within 2 weeks of doing that exam.
Mm-hmm. All right, Colin, this is a great question. I have 140K and want to buy a house in the next year or so. Should I start a BYOB policy first? And will I have enough to access for the down payment still?
It depends.
That's a call right there.
I was thinking that. It depends. Oh, there it is.
It depends. That's a phone call right there. So, I mean, it just depends. So what I would just say is that schedule a call, because it has to make sense to you, not to us, by the way. It can make sense to us all day long, but it has to make sense to you for you to move forward. But yeah, just schedule a call. The link's in the chat. Just grab a time and someone can go through the numbers with you and see how it would work. Because there's a lot of moving parts and pieces for that question right there. Antonio says, I lost 110 pounds. Congrats. Hopefully it was on purpose. Do I contact the insurance carriers directly for an updated info, or do I go through the team? I mean, I would say your I team, your I person, implementation agent.
Check with your implementation team and find out what you would need. I would guess that you would need some kind of physical from the doctor, some kind of documentation to kind of show this amazing feat that you've done, and whatever else they might need to improve the ratings. I guess that's what you're looking to do. So congratulations, man. That's awesome.
Yeah.
Health is wealth. So it's awesome.
All right. What he's not telling you is his ex-wife was 110 pounds. I
had like 6 different things. You better find that 110 pounds. No, yours was funnier than anything I thought of.
Yeah, dad joke right there. All right, Lauren says here, on the big beautiful bill, a loan interest is deduction through my policy, ? If I buy American.
We're not tax professionals, but maybe.
Maybe, yeah.
Hey, Chris, I think this question came up one other time, and I think you were going to look into it with your
I did. I did look at that here. So this is actually, it was a very interesting answer. Let me just pull it up here. I sent it to Steven.
Steven's looking for it. Look at him. He's going to find it.
All right. So he said, let's see. No,
that's a very convoluted answer.
All right. So,
or nuanced, I guess I should say.
Yeah, it's kind of, it's early in this whole thing. So here's how he responded, and this is long. He said, using a whole life policy to finance a car under the big beautiful bill is still waiting on significant IRS guidance, interpretation, and regulation. So again, I'm not a CPA, not giving tax advice. Consult with your own CPA on this. Is what my CPA told me. He said, if it's a personal whole life policy loan, if you own the policy and borrow against it personally, the IRS treats interest as personal interest, which is not deductible. Even if the rate matches what the bank charges, the loan is still considered borrowing from yourself, not for qualifying lender. So no deduction on that one for the big beautiful bill. Now, this is the interesting part. Let's say your policy is COLI, is company owned, by your entity, your LLC or whatever company. Here's where they're waiting for final IRS guidance to define qualifying lenders, which was left undefined in the bill. If your company owns the policy and issues a formal loan to you, who is an employee of the company, so again, you would probably be an employee of the company, the rules may be different. If it's structured properly, this could be treated like a loan from a third party. Key factors that strengthen the deductibility under OBBBA. The company and you are legally separate, meaning it's an entity. It's not a DBA. It's actually like an entity, an LLC, a corporation is what I'm trying to say. The loan terms are arm's length. This is very important. We talk about this a lot. Market rate interest, formal repayment schedule. So when we always talk about making loans from your policy, even if it's personally, always do a note. So we always give you, like, we put them out all the time on PMC and that, do a sample or do a promissory note from you to you, or from, in this case, your company to you, with a repayment schedule, like an amortization schedule, which you could do on bankrate.com, which we always suggest you do anyway. The funds are used to purchase a qualifying vehicle. That's key. Qualifying vehicle. Look that up. The result, interest could be deductible if the conditions are met, and the OBBBA allows non-bank financing sources as qualified lenders. So that's the thing we're waiting on, is that definition of what is a qualifying lender. I know it's not definitive for now, but the bill was so huge, it's going to take some time to work out the details. Anyway, you asked. There it is. Now Ed's probably even more confused. Consult with your CPA to get the same answer I got.
There we go. Wow.
I understood just as much as Cash did. I did great.
Yeah, he's being a good boy.
This is another good question from John here. Would it be beneficial to take a policy loan each month in the amount of your monthly bills, one of which is the premium for the policy, then at the end of the month, when your income comes in, just repay the policy loans? I'll just give a quick answer on that one. No, in my opinion, because you're incurring interest on the loan. Yeah, you're incurring interest on expenses that typically you would not have interest on. So you're actually adding a cost to your cash flow when you don't have to. So
It's interesting. We've been hearing this a lot more lately, and I don't know why or where it's coming from, but this seems to be coming up a lot more. And it is interesting. It really is that you know, I don't support this. I don't teach this, but R. Nelson Nash did.
Well, I think other people talk about it, and so it kind of feeds in, leaks into our conversations. I think.
Well, and I think too, Nelson talks about it, saying though, in a
20
long
years.
perspective, and in 20 years, if you built up all these policies, all this cash value, you should be able to finance every single thing in your entire family's life through a policy, which I actually think would make sense. Imagine if you had $3 million of cash value in your policies. You could take loans every single month, and then when windfalls of deals or investments come back, put it back in, and you can cycle everything through, kind of using it as a checking savings account. So I think theoretically, long term, you can make it happen. It just would take a lot of cash value built up and very consistent income and a lot of planning. But I think maybe it could be possible.
I think you're skipping a lot of years, right? Like that's
Yes.
you're skipping a lot of years, and I think part of the, I don't know if I'm right in thinking this, but I think part of this, because I know people do this. Someone put it in the chat that they actually do this method and have been using it for a long time. It's like you're using velocity banking for this whole system. But like Chris, I have Chris in my head saying that's just lazy. Like that's not how you want your money to work. That's not banking, because you're, like you guys said, you're paying interest on it. So I think there's all these different ideas of everybody trying to fit it into how they think about it, which is awesome. But I would say no on this as well.
Well, the other piece to think about in this is if you have cash value and you can put it into an opportunity that generates more passive income, then you can use that passive income to buy your groceries, buy your bill, pay for your bills. So
that's Joe's gas station example that I never understood until I understood.
Yeah. So it's just a matter of how can you maximize the use of that cash value?
Yeah,
and just going and buying groceries is not always the most beneficial.
Yeah, like Sir Arrowhead's comment here. They have a policy, right? They're doing some stuff with it. They're debt free due to the policy. Step one, right there, get rid of that bad debt. They've had it for 7 to 8 years now, so they've had it for some time. It's been growing, $500K, but now looking to buy another one after the house is done. So kind of what they're doing is a whole cycle of debt free first, had it for some time, built it up, doing something very powerful with it, and now it's time for the second policy, third policy, etc. So,
the dead Oreo we talked about on Wealth Webinar.
There you go. Here you go, Joe. This is for you. Antonio says, I need to get a hold of someone regarding the all-in-one HELOC. Who should I reach out to?
Hello.
So, so Joe, if someone wants to put in your information into the chat or something like that, or we'll get in touch with him. Then John has another comment here. Doing velocity banking with a HELOC. So first off, awesome right there. You've already got a good mindset going. I have wondered for a long time if there would be a benefit to paying $300 per day instead of $9,000 per month. I mean, the more you put in, the less you're going to have.
No. The average daily balance is calculated with the HELOC on an average daily balance. So if you put in $300 per day, every day you're knocking down that interest. So instead of just once per month. So
it's faster.
Yeah.
I learned from Bo.
$300 per day would increase the velocity.
Yeah, but if you're putting the 9,000 in up front each month instead of 300 per day throughout the month, the $9,000 would be better. So it depends where you're starting.
That's what I was saying. If you do the 9,000 at the beginning, then the balance is lower for the next 30 days.
30 days, as opposed to working down.
It just
Unless
depends.
you're in a spot where you're getting paid every day through multiple sources of income, then it's just a matter of as soon as you get the income, throw it at the HELOC. Yes, but yeah, as with Steven's point, the 9,000, if you have it now, just throw it into the HELOC.
Yeah, just do the math.
Right.
I mean, it's just math.
Yeah, and as Joe says all the time, and we talk about and teach, is if you've got that money coming into your economy, like where's it going, and why is it not just going right in that HELOC? So it's when that money shows up, that's where it should be landing, is in that HELOC. So a lot of times we'll hear someone say, I've got a $50,000 HELOC balance, but I've got $25,000 sitting over in a savings account at 0.4%. Let's move that over, right? Let's pick that up and move it in the HELOC.
So,
So Craig, what you're saying, it's simpler to manage money from one area than trying to have money in all these different accounts all over the place. Perhaps. Okay.
that's what I've been saying. You're not
What-
paying your gas bill with blue money and the electric bill with red money. It's all green. Pay it out of one pot.
There you go. All right, Dexter has a follow-up one. He said, I think I heard this last week. Monthly premium policy, I'm able to find out monthly how much more PUAs I can add to the policy. Question mark. All policies are worth One America. Yes, you can. You just call up your implementation person or One America and ask. That other policy is 5 years old, FYI. Okay, so it's an older policy. That makes sense. I think you had another follow-up comment here where he said, yeah.
And Dex, I'm going to send Dex a text right now, the one that I send. You can just CC your implementation specialist. I'll give you who to ask, what question to ask, why it's important, and I'll just send it to you next.
Yeah. So yeah, obviously with time you have more dividends coming in, so the cash value is jumping up more each year because it's been there for a while.
Yeah, Dexter, as far as your math goes, you would want to be sure that you're looking at how much premium went into the policy when you're looking at how much cash value you have versus how much premium has been paid in, and exclude the policy loan repayments you might have made. And as far as finding out how much extra PUA a policy can hold in general, some will reset every month, some will reset every year. Like I think I saw a comment in the chat here. So they're not all the same. And it doesn't necessarily have to do with the mode being monthly or yearly. It depends on the policy structure and the company in some cases. So just find out every month or ask if it's going to reset the next month then or not. So the insurance company can tell you.
Yeah, Linus has a story on that, right? And I do as well. Like we just got to Connor's third year. It's a $10,000 a year policy. We asked how much additional, like 3 weeks ago, how much additional PUAs can we put into this policy? And the answer was over $13,000.
Yeah. So just got to ask. That's awesome.
Just got to ask.
All right. Last question here. Tattooed Spirit or Jeff, as he's normally called. What is more important, paying off your 10K loan with cash that you have or saving more cash and starting a new policy? He says, I have 35K in cash in my safe. Thanks for considering.
He's got some go money. Jeff got go money.
Yeah, it depends. Honestly, it just depends on what you're trying to accomplish, depends on what your goals are. And if a second policy will help you accomplish those faster, it just depends. So it's a great question. I would just recommend scheduling a call. That is a very good question.
If there's $35,000 in a safe, why is he paying interest on a $10,000 loan?
That's what I was thinking too, Joe.
Yeah, there's that. Yeah, that's a good point right there. A good point to make.
We see that every day. That shouldn't surprise anybody on here. We see that exact scenario every day where people are sitting on like a bunch of cash. A lot of times in checking accounts earning zero. Here, safe's not paying you anything, and then they're paying a bunch of interest on credit cards and in loans. It's just they're not making the connection. I don't know why.
It's intentional. It's all the marketing. It's all the it's intentional. That's why it's so hard to break that pattern for all of us. Once you see it, though, you can't unsee it.
Now, this could be just a regular loan. This could be not going back to the insurance company.
That's true.
So maybe
that's a good point.
So now he wants to take the $10,000 out of the safe, run it through a policy, then borrow it to pay the loan. Now that would be the way to do it.
Yeah,
Agreed.
I like that one.
There you go. You can just do something per month, overfund it, and pay that loan immediately, and then pay yourself back what you're going to pay to the loan.
There you go. All right, Chris, you want to close this out?
Pay the third party.
All right, cool stuff. We'll wrap it up with this right here. Carlos said, love the content. Literally almost bought $1 million death benefit policy since he's 27 with a sales rep. Watched your videos, decided not to pull the trigger on that trap. So nice work, Carlos.
Good job, Carlos.
Hopefully you've connected with one of our mentors already to start a whole life policy so it's with you the rest of your life and take advantage of it starting immediately. At 27, if you're making good money especially, it's perfect for you, man.
Absolutely.
Good stuff. All right, shut her down, Chris.
Cool. All right. Well, hey, folks, thanks, everybody, for your great answers, your great questions. It was phenomenal. Some really, really good in-depth questions coming in, which I always love because they're not the basic softball ones. The more you challenge us, the more we all learn. Like Jason mentioned earlier, he's here to learn. We're all here to learn. And that's, I think, the best part about Ask Me Anything Happy Hour. So with that being said, I'll close this sucker down. And we will see you tomorrow for the Quick Start webinar at the normal time, 1 p.m. Until then, talk soon.